Yes. Sun Moon Mutual Funds, an approved mutual fund sponsored open-ended oriented scheme, Chanakya Opportunity Fund. Now, an open-ended scheme means any day you can enter, any day you can exit. There were three plans: Plan A, dividend reinvestment plan; B, bonus plan; and C, growth plan. At the time of initial public offer on 1/4/1995, Mr. Anand, Mr. Bachchan, and Mrs. Charu, three investors, underline, invested 1 lakh rupee, each of them 1 lakh, 1 lakh, and 1 lakh, and they have selected plan B, C, and A respectively. So, first one selected B, second one selected C, and third one selected A. The history of the fund is as below. NAV per unit face value was 10 rupee. Plan A, B, and C 28th July 99, 31st March 2000, and so on up till 31st July 2005. You have the details with you. Now, how do I understand this table? Dividend was 20%, and dividend is always on the face value. If you want, just make a note in the textbook. 20% is always on face value. In this case, it is 10 rupee. And in yesterday's class, I told you face value is not given. You can assume that it is 10 rupee. NAV can't be assumed as 10, but face value can be assumed as 10. So 20% will be on 10 rupee. And plan A, plan B, plan C, NAV on that date is given to you. Understand, I'm talking about 28th July, that line. On 31st March, 70% dividend was announced in the dividend plan, and then 5:4. Now, make a note, it should be understood as 5 bonus units for every 4 units held. That means if you're holding 400 units, then you get 500 bonus. That will become 900 from next day. Next time when they issue bonus, for them base will be 900. And then you continue this way. And same thing again, 31st October 2003 and so on up till 31st July, you have all the details. Now, in the question, there were three plans: dividend reinvestment, bonus, and growth. For growth plan, there is no story given in the table because in growth plan, there is no activity. Correct? People will give you money and mutual fund will invest. And that's all. The NAV keeps going and there is going up, and there is no question of getting bonus or reinvesting dividend. No need to even calculate amount of dividend attributable. On 31st July, underline, all three investors redeemed all their units. Redeeming means giving it back to mutual fund company. In simple words, sold. Calculate annual rate of return. Please underline the word annual, because here the fund was launched on 1/4/1995 and you are selling it on 31/7/2005. So when you calculate total return, you get a very big number. But question is only to find out annualized rate of return. Consider the below. Number 1, long-term capital gain is exempt from tax. 2, short-term capital gain is subject to 10% tax. Number 3, security transaction tax is 0.2% only on sale or redemption. You can ignore education cess. Now, one by one, who is the first investor? Mr. Anand. Start in your notebook. Heading Mr. Anand, and as per the question, he has selected plan B, and plan B is bonus plan. Heading Mr. Anand, bonus plan. I want you to understand the starting point correctly. Go to the first para of the question. They said they invested 1 lakh rupee and starting point was 10 rupee. That means number of units he purchased on 1/4/1995 is 10,000. On this, bonus will be calculated. Start. Number of units purchased is equal to 1 lakh rupee divided by 10. That is 10,000. Now, Mr. Anand is under bonus plan, and when was the first time bonus was given? 31/3/2000, and 5 bonus units for every 4 held. That means with cross multiplication, you can find out for 10,000 how many additional units. But remember, after those bonus units, his number of units will increase. Next time when bonus is given, which is on 31st March, base will be the new number. You should not do bonus on the base every time. Base will also change. Start. 1/4/1995 units was 10,000. This is the starting point. On 31/3/2000, bonus units will be 10,000 into 5 divided by 4. So simple cross multiplication. For 4 held, 5 bonus. For 10,000 held, it will be 12,500 bonus. Therefore, add another column. Units after bonus will be 22,500. You had 10,000. Now you have 22,500. Next bonus was given on 31st March 2004. And this is one bonus for every 3 held. Please understand this 1:3 is one bonus for every 3 held. That means it is 22,500 into 1/3. You will be allotted 7,500 bonus units. So balance will be 30,000. One more bonus was issued on 24th March. That will be 1:4. So 30,000 into 1/4. 7500, 37,500. So when you sell or redeem, you'll be able to sell 37,500, though you invested only 10,000 into 10. Now tell me, from taxation angle, the first two bonus 12,500 and 7,500 will get exempted because they said in the question long term gain is exempted. But the third one, the last one that you got these units on 24th March, and after the table line says on 31st July all 3 investors redeemed all the closing balance units. That means on this you will end up paying some taxes. Make a note after this. Since holding period for 7,500 units is less than 1 year, since holding period for 7,500 is less than 1 year, this will be taxable. This will be taxable. In bracket, go to the question. It says STCG is 10%. So in bracket, at 10% STCG. Now tell me, how do we calculate his net gain or net profit? All 37,500 he'll be selling. Selling at what NAV, by the way? In question in the table you have 31st July, and which plan has he selected? Bonus plan, that means plan B, and plan B NAV is 22.98. That means he'll be selling all 37,500 units at 22.98 rupee. From that you have to minus the cost of acquisition, and then you have to pay some taxes, and then the STT adjustment, and then you will get to know net gain after all taxes. Start. Sale value or redemption value is equal to particulars amount, small table, particulars and amount. Sale value or redemption value is equal to 37,500 units into 22.98. That will be your inflow 861,750. Now, since you are anyway calculating net benefits, you can take out even STT. And in question, it is clearly mentioned STT is only on sale and not on purchase. So it is 0.2% on sale consideration. 861 750 into 0.2%. And just now we have written there will be some short-term capital gain. Now that short-term capital gain, and this is where the confusion is. How do I consider the cost? One approach, 22.98 is the sale value minus cost is taken as 0. Correct? Entire sale consideration will become your gain. On that you will have to pay. Alternate way, 22.98 is sale. From where did I get this 19.95? On the day this bonus was given, 24th March, if you go to the question, under plan B, you have to go to correct box. 24th March is when this bonus was given. On that day, plan B is bonus plan. The prevailing NAV was 19.95. So if I count that as my cost, then 22.98 minus 19.95, that becomes my gain. Into only 7,500 units you're not paying on the total, into taxes 10%. This is one way, but this can be presented in one more way, that is assuming cost of bonus is 0, then this calculation will be 22.98 minus 0 into 7,500 into 10%. We will do in both ways. In exam, any one way is enough, but you have to clearly write the note. Copy. 22.98 minus 19.95 into 7,500 into 10%. This will give you 2273. This is not net profit, this is simply net receipt. Understand it as net cash inflow post tax. We still have to minus the original investment to find out the rate of return. Here I want you to write a note properly on this STCG. Write note. If cost of acquisition for bonus units, if cost of acquisition for bonus units is considered as 0, then STCG will be equal to, show the workings, 22.98 minus 0 into, correct, 7,500 into 10%. Next line, in bracket, reference section 55, inverted comma, cost of acquisition in Income Tax Act. Yes. This is net receipt. There is another such income tax ambiguity which I'll discuss after completing the sum. It will be deviation if I start it now. But they have sorted this problem 2 years back. There was similar confusion. I'll discuss it later. Now, how do I calculate rate of return? How much was investment value? Just 1 lakh rupee, first paragraph, and now you're getting 857 753. The difference between this divided by 1 lakh into 100 is your gain, but that should not be considered as annualized gain. That will be the total holding period gain, and holding period here is starting from 1495 to 31st July 2005. You'll have to count years and months properly. Start. Therefore, holding period Holding period will be, tell me first how many years, 95 to 2005, 10 years, plus I have to even add April, May, June and July of 2005. That means it is 120 plus 4, 124 months. Correct? 10 years into 12 months plus 4 more months of this year. So whatever return you get is not for 1 year, it's not for 12 months, it is for 124 months. Therefore, annual rate of return is equal to, annual rate of return is equal to, you know what to write, 857753 minus 1 lakh by 1 lakh. If you directly do into 100, you will get total return. Correct? But if you want annual return, into 12 by 124, to 12 by 124, then into 100. If you're not comfortable with this style, you directly do into 100. You will get a number, but that is for 124 months. Then you'll again have to do cross multiplication. If so much is for 124, then how much is for 12? This comes to 73.33 annualized return. Just to get the comfort, in Calci, please do this. 857,753 minus 1 lakh by 1 lakh into 100. Big number. Correct? But this is for how many months? 124 months. Divide this by 124. This is monthly. Then you do into 12. You get annualized. If you are more comfortable in this way, go by this. Because holding period and annual need not be same. This guy is holding for 124 months and question is for 12 months. If they're holding for 12 months, then you don't have to do into 12 by 12. You anyway get the same number. Easy. Who was the second investor? As per the question, Mr. Bachchan. And Mr. Bachchan is under growth plan, correct? He has selected plan C. And plan C is growth plan. Heading Mr. Bachchan, growth plan. I want you to think and tell me how to work out. This must be easy. Tell me how much is investment made. Same 1 lakh. And how many units? 10,000. How many units he will be selling? 10,000 only. In growth plan, number of units will not change. But at what NAV he'll be selling? 82.07. That means 10,000 into 82.07 is sale consideration minus the cost of acquisition, and then wherever tax applicable. Here STT will be applicable, but since he is holding it for more than a year, there is no STCG applicability anyway, and they said long-term capital is anyway exempt from tax. So this becomes very easy. There is no intermediary calculation. He bought, he sold. Yeah. Start writing. Number of units bought. First heading Mr. Bachchan, growth plan. Number of units bought, 1 lakh rupees by 10,000. Very simple calculation, particulars and amount. How much is redemption value? All 10,000 units sold at 82.07. You have to take the correct NAV. Plan C NAV is 82.07. That means cash inflow is 820,700. Only thing you have to minus is security transaction tax. That is on full sale consideration 820,700 into, as per question, 0.2%. 1641. No need to calculate any STCG because there is no purchase, sale, additional units, free units in between. So this is your net receipt on redemption. I have a small question. What if there is exit load? Then you have to minus even that. Correct? Entry load is a cost. Exit load is reduction from income. So if there is exit load, minus that also. What comes to your bank account net? That should be taken. Yes. Now tell me how to calculate rate of return. Same holding period, 124 months. All of them started on same day and sold all units on same day. So that time period is same for all three investors. Easy calculation now. 819059 minus 1 lakh rupee. Correct? Divided by 1 lakh. This will give you total rate of return. But you want it for 12 months. So you can do into 12 by 124. 69.59%. Done. Third investor, as per the question, Mrs. Charu, and she has selected plan A, and plan A is dividend reinvestment plan. Listen before we start the working. In Calci, 10,000 units into 10, 1 lakh was invested, and the first dividend is paid on 28th July. And dividend is always on face value and not on NAV figure. That means this much amount, 1 lakh into 20%, was supposed to be paid. But because it is dividend reinvestment plan, money will not be paid. Additional units will be added. Now in Calci, 20,000 rupee divided by which plan we are talking about? Plan A. And that day NAV was 30.7. That means you have to divide that 20,000 by 30.7. That many units will get added. How many units? 651 point something. And then next dividend, when it is to be paid, it will not be on 10,000. It will be 10,000 plus this unit into again on 10 rupee, because dividend is always on the face value, and into 70%. Again that day you have to divide by prevailing ongoing NAV. Then you have to add some more units. This way you have to continue doing up till 31st July. And in the question I can see there were 5 incidents where dividend was reinvested. That means this will be a slightly lengthier working note, because you have to first find out number of units held, correct, on the day of sale. Yes, this I'll discuss later. Start. Mrs. Charu, dividend reinvestment plan. Heading, dividend reinvestment plan. Yes, understand the table first. We'll go slow, and I don't want you to copy. Yes, all of you concentrate on the slide. You start with 1495. Anyway, there was no dividend. 10,000 units purchased, 1 lakh divided by 10. And this 10,000 will be the base. On, go to the question, 28th July, 20% dividend was supposed to be declared. So it is 10,000 units into 10 rupee into 20%. So that becomes 2 rupee dividend. That will be 20,000 rupee. Instead of giving that money, they'll allot you units. You have to take 30.7, because that's the plan we are talking about. That many new units will get added. 651. Now base will be 10,651. Next time when they pay dividend, dividend is directly written as 274, because it is percentage on 10. So there is no need of confusion in working. And that becomes 10,651 into 7. That much was dividend attributable. That 74,557, instead of paying money, go to the question. That day ongoing NAV was 58.42. That means now the 74,557 will be divided by 58.42. That many new units. This will be done again and again 5 times as per the question. So this investor will have total 14905 units on 31st. Now this is a time consuming working note. Now that's why I told you a long term investor will go for a growth plan. He will not even log in and check what's happening with my mutual fund. I invested 1 lakh, NAV is just growing. 1 lakh, that is 10,000 units, won't change. But in reinvestment plan and in bonus plan, number of units also will keep changing. This working note you have to do properly. Start. Date, dividend. Remember, this is dividend attributable. This is not dividend paid. They will calculate but won't pay. Dividend and then additional units and then closing units. Go to the question 1495. So starting point, no dividend anyway. You start with 10,000, closing is 10,000. As per the question, first dividend was on 28th July and you are holding 10,000 units, face value 10 rupee. So it will be 2 rupee dividend. That comes to 20,000 rupees. But they won't give you money. They will allot units that day. And which NAV to take? You're working out under plan A. That means you have to go by 30.7 rupee. That day's NAV. That gives you, I think, rounded off number 651. If you want to write decimals, no problem. But from here, everywhere you'll have slight difference. Finally, you may have 2-3 extra units as per the calculation. Don't worry. If you have already written decimals, continue. Sorry, let's complete the sum first. 10,651. Then that becomes base on which 70% dividend. So that will be 7 rupee on 10. And this is 74557. And this you have to repeat till the end. Parallelly, if you're thinking about taxes, even here, 24th March, that will come under STCG period, less than 1 year. Other things will get exempted as LTCG. I'll discuss. Let me know once you're done till 14905. Because of rounding off, you may have 1 or 2 units difference. Anyone who is not rounded off, what's the number you have? 905. After the table, understand for the last line item, holding period is less than 1 year. That will come under STCG. Just write a note. Holding period for units allotted on 24th March. Holding period for units allotted on 24th March 2005 is less than 1 year. Full stop. Hence it is taxable in bracket STCG. Now, next, to find out total cash receipts, you will be selling 14905 units and go to the question. Under this plan, what is the sale consideration? 53.75. Correct? You have to go to 31st July, go to plan A, and plan A NAV is 53.75 minus there is STT, and then there is some short-term capital gain taxes. Start. Net receipt, particulars and amount. Redemption value or sale value 14905 units into, as per the question, NAV is 53.75. On that, we will have to pay STT, and then STT is 0.2% on sale value, comes to around 1602, and then STCG for only 1144 units. You're selling at 53.75. On that day, NAV is 48.10, and on that you have to pay 10% taxes. Sorry, can be, but I have not considered that. Seven nine eight 896. Even here, holding period is same 124 months. There is one possible doubt here. We will discuss. Rate of return. I'll discuss. Annual rate of return is equal to. Now my question, how much is net cash inflow? 798,896. How much is your investment in this? 1 lakh plus 1 lakh plus dividend. Should you consider that dividend? But it's supposed to receive dividend, correct? Money never came to you. So should we consider that as cost of acquisition? Hope you're understanding my question. How much did you invest? 1 lakh rupee. How much are you getting now? 798,896. In between, some dividend was supposed to come, but it never came to you. So should I consider those dividends also as your income received? Is it actually income even received? Did anything come to your bank account? Just see this slide, a basic explanation. This is a class note. If you understand, no need to copy. If you want, you can copy. Small explanation story is given to you. Mr. X has invested 10,000 rupee to buy share. Separate story, not this sum. He received dividend of 2,000. He buys additional share of 2,000. At the end, sold all the shares for 15,000. What should be his rate of return? His out of pocket investment is 10,000. I'm going to the other part of the slide. End value of investment is 15,000. So holding period rate of return is 15 minus 10 by 10 into 100, it is 50%. Now his investment is only 10,000. In between, that dividend came and the dividend is reinvested. This is for share. Now apply similar concept here. How much was your out of pocket investment? That was only 1 lakh. The dividend which was attributable, I told you 2-3 times, they will calculate but they will never pay. Therefore, when you consider cost of acquisition, it will still be 1 lakh rupee only. You never invested those dividend. Don't say, sir, it first came and then I reinvested. It never came. Understand, they only calculated in an Excel sheet, not even a journal entry is passed. They never shifted it to a reserve and this and that. They calculated and then they reinvested. From your angle, 1 lakh was outflow, 798 is your inflow. So directly the difference between these two should be taken. Start. Annual rate of return is equal to 798, 896 minus 1 lakh divided by 1 lakh into 100 will give you total returns, but since you want annual, it will be into 12 by 124, then into 100, 67.63%. Now, if they ask you in exam, which fund has performed better, the one having higher rate of return, because all of them started on same day, ended on same day. Their investment was same 1 lakh rupee. So comparison is 100% doable. Where do you have higher return? Bonus plan. If they ask you which is better, you write that as one more line conclusion. Yes. Only if they ask in this question, they haven't asked. Yes. Now, end of this solution. Another similar ambiguity like the 55 section bonus issue here is very interesting. I want all of you to read. This is not connected to this particular concept. Heard of ULIPs, unit linked? Yeah. For those who do not know, I pay 2 lakh rupee premium and take life insurance coverage up to 20 lakh. If something happens to me, 20 lakh will come to my nominee. This is what the traditional insurance LIC kind of schemes were. From couple of years, some companies have started investing your premium. So you give 2 lakh and that 2 lakh we will invest in stock market. Unit linked. Yeah? You will be allotted some units similarly. And then every year you pay premium and that money gets invested. And we also give you a flexibility. If you want to stop this insurance scheme in between, you can stop. That way, that day, whatever is the fund value, that much will come to you. And if something happens to you, don't worry. Whatever was the coverage, 20 lakh rupee we gave to you, it will come to you. Now understand the catch here. I paid 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh, 5 years. Most of these ULIPs are 5 years payout. That means I would have paid 10 lakh premium. My coverage is up to 20 lakh. But the 10 lakh is invested in stock market. And the 10 lakh might have gone up to 12.5 lakh. And if I die on first day of 6th year, they won't give you 12.5 lakh, they'll give you 20 lakh rupees. Because the coverage is up to 20 lakh. But what if the fund value crosses 20 lakh and that becomes 37 lakh and then I die, then my nominee won't get 20 lakh, they will get 37.5 lakh. So it is fund value or insured value, whichever is higher. That means, hope you are following what I'm saying. That means you invest 2 lakh, 2 lakh, 2 lakh, and that money, it is not just insurance, it is also going to stock market. What people started doing because of this, instead of investing in mutual fund or stocks and you pay taxes on that, and because ULIP was tax free before the amendment they made 2 years ago, people used to heavily invest in ULIPs, and you get the benefit of tax exemption, and you also get the insurance coverage. Now you don't have to have one insurance separate and one investment separate. In a single instrument, you're getting both benefits, and you also had a lot of tax benefits on ULIPs. People used to invest premium like this, 5 lakh rupee, 5 years, 25 lakh, and then market goes up. Number one, your 5 lakh normally into 10 times, 15 times you get the coverage. And if fund value crosses the coverage, then that money is going to your family members. So in a way, you escape tax. You combine two instruments, became a super tool for a lot of people. 2 years back, government came with, they got to know many are doing, even high net worth individuals started doing this. Then government came with a cap that ULIP exemption is applicable only if the annual premium is less than 2,50,000 rupees. So now only up to 2,49,999 if you have a ULIP, and then something happens and that insured value money comes back, etc., it is exempt. But even then, 2,50,000 premium per annum. So if I take one such insurance ULIP scheme and pay 249 for 5 years, after that me paying is done, then I can take one more ULIP. Hope you're following. At any point of time for a year, it should not cross 2,50,000. That means 249, 5 years I pay, that is done, and then I take one more, and then again I pay 249. I'll have two coverages, and both are going to stock market. So if stock market is going up, your investment value is going up, and once 5 years is over, you can stop that plan any day. So it is more like you buying mutual fund units or you directly investing in stock market. But there are equal number of people who will tell you that you should never mix an investment with an insurance. Insurance is for some other purpose altogether. Investment is for some other purpose altogether. Because the problem is, after many years, and if there is a market crash and then your fund value comes down drastically, even then you will get your 20 lakh only, the insured value. But then 20 lakh after many years will be very less powerful. Therefore, many have this caution approach also towards mixing investment and insurance. Couple of my friends also have made good use of this before the amendment came. They were investing in stock market and mutual funds, and they had separate insurance, and they shifted to this ULIP and invested heavily, and there was no upper cap for tax exemption, and now it's only 2,50,000 per annum, and most of the insurance companies are giving you 10 times of your premium as coverage. So 249 I pay, 24,90,000 I get. So till my fund value crosses 24,90,000, that's the money. Once it becomes 27 lakh is the money. After that, if something happens to me, my nominee will get bigger than 2490. So this was one ambiguity that they created about ULIP, and people were heavily using it. 2 years back, there was an amendment. Now it is there in the syllabus. ULIP is not fully exempt. ULIP is exempt only if the annual premium is less than 2,50,000 rupees. So this way, even the bonus share, bonus units, there is still that confusion. There are two views. I have gone by taking the prevailing NAV. If you take it as 0, then accordingly your taxability will be slightly higher. Clear? And please read about this ULIP taxation. It's a recent change made for your examination. It's not even an amendment. It's part of syllabus now, because this was made 2 years ago. But before that, many investors made good use. By the way, it's not retrospective change. After the budget, 2,50,000. So before that, whoever has heavily invested, when they will get full tax benefit when they withdraw the money, or something happens to them and their nominee gets, it will be fully tax exempt. Yeah. Question number 12. Corpus, an asset management company, AMC, on 1/4/2015 has floated two schemes, dividend plan and bonus plan. And please understand, I told you something in theory discussion. Dividend plan should be understood as dividend reinvestment plan, and then bonus plan. Mr. X, an investor, has invested in, underline both the schemes. Now same investor, two schemes. The following details except the issue price is available to you. That means at what rate he purchased, that NAV is not given to you. 1/4/2015, that itself is a question mark. Basically it's a reverse working sum. You'll have to come back from the end value maybe and find out how much was the investment made. After that, there are two incidents of bonus, 31st December and 31st December 2016 and 18, and three places where dividend was calculated but not paid because it's a reinvestment plan. And you have the NAVs on all other dates except the starting point. Additional details: investment amount is given to you, but number of units is not given to you, that you will have to calculate. Second, average profit is given. Please underline the word average. This is not total profit. This is your annualized number. Correct? Even that number is not given for bonus. And then average yield. Again, the word is average. That means they have calculated annualized figure. For one, they haven't given. For the other, they have given 6.4%. You are required to calculate, underline the issue price of both these schemes as on 1/4/2015. It's a complete reverse working. Now from where do we start? In Calci for dividend, just do some basic workings. You invested 9,20,000, keep that aside. Average profit is 27,748.6. This is average, should be understood as annual. That means if I find out how many years he was in this scheme and then add 9,20,000 to that, I will get to know total cash inflow at the time of redemption. You have investment. If you find out total profit, that will be the value of cash inflow. Now, when did they launch this? 1/4/2015. And you are calculating up till 31st March 2020. How many years? 15 to 25 years. In Calci, 27748 into 5. That's the total profit made by him. Plus, he invested 9,20,000 rupee. That is the total cash inflow. This is not initial investment. This is the total cash inflow on the day of redemption. Correct? And we are talking about dividend plan. Go to question. Go to NAV dividend plan is 49. Able to follow what I'm saying? That means this number in Calci, if you divide by 49, you will get to know how many units he had on the day of redemption. This many units he has sold. But question is not this. Question is how many units he bought at what rate. Able to follow? Out of that also we already have one number, investment 9,20,000 rupee. That means if I can find out one of the two, either number of units he purchased or NAV on the starting day. One of the two if you get, the other number you can calculate. Able to follow? Sir, we'll assume 10 rupees, so we'll do 9,20,000 by 10. 10 I told you, 10 can be assumed as face value, but that may not be the issue price or the NAV. For dividend, you can take 10 because irrespective of NAV, dividend is on 10 rupee, but you can't assume that he started at 10 rupee. Remember, 10 is there at the time of initial offer. Correct? One day late also it can be 10.1, it can be 10.2 like IPO. Or day late also, price will not be the same price. Correct? Same way, tell me how to approach bonus sum. You have 6.4% average annual yield. You have kept it for 5 years. That means if you do into 5, you will get to know total holding period rate of return. You also have investment. On investment, if you do this, you will get to know return. Then again, same way, you'll get to know how much is the total value of cash inflow. And you also have 44 rupee, the NAV. You'll get to know how many units you sold. But then those units is what you have sold. That is after 2 rounds of bonus. In between you got bonus. Now you have to do reverse calculation. Units after bonus is with you. Bonus ratio is with you. You should find out units before bonus. Correct? And like this you have to do 2 times reverse working because bonus was paid twice. From this you can go back and find out how many units he originally bought. You have the original investment, 10 lakh divided by number of units will give you NAV at which he entered. So both are reverse working. Start. First plan is dividend reinvestment plan. Only for your reference, if you want, write a star and on top of the page make a note. Dividend plan should be understood as dividend reinvestment plan, because question says dividend plan, but it is dividend reinvestment plan. Yes. Start. Value of investment on 31/3/2020. Value of investment on 31/3/2020. This is like redemption value, correct? Is equal to, see what is there on screen. You invested 9,20,000 plus you made 27,748.6 average annual profit, and holding period is 5 years. Therefore, that into 5. So original cost plus profit is the closing value. 5 years because you started on 1/4/15 and ending on 31/3/20. This, do we know the NAV on 31/3? 49 rupee. So if you divide by 49, you'll get to know how many units he has sold. Next line. Number of units on this day will be 10,58743 divided by 49. So he sold 21607 units. But this is not the question. Question is how many units he purchased, or how much was the NAV at entry date. This is your exit date, correct? Both 49 and 21607 is exit day, but they want entry day data. There is a small class note. First understand this and then you see whether this is to be written. My suggestion, it should be written. First understand. We know the investment on 1/4/2015, 9,20,000 already given. That means what should be the approach now? We can calculate number of units bought on 1/4/2015, and if we do that, the solution is over, because you have one number, 9,20,000. You need either number of units or NAV. For this purpose, we have to do number of units calculation bought on each dividend date, correct? You go to the question. Suppose you have X units. There was dividend paid on 31/3/17, correct? That dividend will not be paid. You will have units allotted. That will be the new base. On that, again on 31/3/18, some dividend will be calculated, but amount won't be paid. Again, you get some units allotted. Then there is one more dividend at 15%. You get that. After considering that, you reach this number 21607. That means calculation will flow something like this. Units before dividend plus units added is equal to 21607. Let that be X, and from there you can find out, but that won't be final answer. By doing this one equation, you will get to know how many units he had before latest dividend. From there you have to go one more step behind. From there you have to go one more step behind. 3 steps behind, because 3 times dividend was reinvested. Able to follow? I quickly repeat this. 21607 is the unit that you have after the last dividend got reinvested, and that last dividend was on 31/3/2019. That means an equation will go something like this. Number of units held before plus dividend reinvested is equal to 21607. Let the number of units held before is X. Then what happens? X plus X into 10 rupee face value into 15% dividend divided by NAV on that day, 45 rupee as per the question. That should be equal to 21607. With this equation, what you will get is number of units held before last dividend. But that won't be the final answer. That number came after second dividend. That number came after first dividend. That means you have to do reverse working 3 times. That will tell you how many units you started with. And you have 9,20,000 with you. 9,20,000 divided by that will give you NAV at entry date. Did you understand? Now copy this class note. If we can calculate number of units bought on 1/4/2015, then solution would be over. For this purpose, we have to calculate number of units bought on each dividend date. There are three dividend reinvestment incidents. That means you have to calculate it thrice. For this purpose, we have to calculate number of units bought on each dividend date. In this regard, we can draw a small equation or a formula like this. Let me show first. Let's discuss and then you can give a try. All of you on screen, please. See this. We have to go from bottom because we know 21607, that is this number. So units you had before plus additional units, that should be equal to units after. How many units before? We do not know. How many new units? Whatever was dividend attributable to you divided by that day's NAV. Don't divide everything by 10. So that will be on that day basis. That is equal to number of units after. Now we do not know how much is before, but dividend will be number of units you held before into dividend per unit divided by NAV. Now which number we know? 21607 we know. How many units we had before that we do not know. Keep it as X. Now understand the equation. X plus X into 10 into 15%. 15 I'm taking because we are doing reverse working. We have to come from the bottom. 10 can be taken as face value. That assumption is okay, but NAV can't be 10. Face value can be 10. So X into 10 into 15% by 45. 45 is the NAV rate on that day. 45 rupee. This now you'll have to solve an equation. X plus this will be 1.5x by 45 is equal to 21607. When you solve it, you get 20910. Tell me what is 20910? Number of units he was holding before this dividend. Correct? That means this is not the end. This number came after second dividend and that number came after first dividend. That means I have to repeat this two more times. From there only I can go back to the oldest number, the first investment that he made. Did you understand first? Then copy. Dates are very important. Starting from bottom. So 31/3/2019 units held before plus additional units is equal to units after I'm okay if you want to skip one of these lines. If it is easy and you can understand, then directly start with let the units before be X. Let the units before be X. Then equation is X plus X into 10 rupees into 15%. Remember 10 rupees is face value that we can always assume as 10. That is the total dividend attributable to him. That day we are not giving him dividend. We are allotting units and units will be allotted on prevailing rate basis. That day prevailing rate is 45 and after that this comes to 21607. solve the equation. We'll have to do some cross multiplication. Keep it easy. You can do 1.5 by 45 here itself. And then it becomes easy instead of multiplying big numbers. In CA final, if you are not solving equation correctly, I am not responsible. No one is responsible. Number is matching. Yes. 20910. Now tell me, what should be our next equation? That will be for the dividend on 31/3/2018. Again, that will be assumed as x now. So next equation is x plus x into 10 into 10% divided by that day NAV, which is 50 rupee, is equal to this number 20910. Right? Start. One more date, 31/3/2018. Units before plus additional units is equal to units after. Be careful with the NAVs that you take. It should always be ongoing NAV, prevailing rate. So equation is this now, x plus x into 10 into 10%, and that day NAV was 50 rupee. 50 because you're in dividend plan. Don't take 39, you're not in bonus plan. That should be equal to 20910. Again, small equation, x plus 1.1x by 50 is equal to 20910. If you solve the equation, 20500, exact or approx? Exact. As per the question, there was one more dividend before this. That will be the last step. From there we will get to know how many units you had before, and that will be the number of units you purchased. Last equation, one more date, 31/3/2017. Same way, units held before plus additional units is equal to units after. Now it is 12%. So it is x plus x into 10 into 12% by that day prevailing NAV 48 rupee. So units will be allotted on that day rate basis. And this is x plus 1.2x by 48 is equal to 20500. If you solve, you get 20,000 units. That means this is what you started with. Read last line of the question. They want you to find out not number of units. They wanted issue price, at what rate he bought these units. Do you know how much he invested? 9,20,000. You also know now how many units he had purchased. So this by this will give you a rate at which he purchased. So last line, issue price. In bracket we can understand this as entry date NAV. entry date NAV is equal to 9,20,000 rupees divided by 20,000 units. 46 rupee is the rate at which he bought these units. Done. This is under dividend plan. In the question there is one more bonus plan. Here also similar way, it will be again units before plus bonus units and then units after. It won't be dividend now, it will be bonus. And what's the bonus? 1:4, and there is once again 1:5. That means you'll have to work out twice, but it won't be as detailed as this because numbers are there. You don't need an equation also. It's a simple cross multiplication. Start heading bonus plan. Go to the question. What is the data that we have? He has invested 10 lakh rupee and his average annual yield is 6.4%. And we know holding period is 5 years. That means you can find out total profit he made, and 10 lakh plus total profit will give you closing value. And that closing value NAV is 44 rupee. That will give you how many units he was holding on the last day. From there again similar reverse working, we can get the entry point. Please start. Value of investment on closing day is equal to, he invested 10 lakh plus, as per the question, annual yield is 6.4% for 5 years, and rate of return is always on initial investment, so it is 10 lakh into 6.4%. that will give you annual profit, but he was holding this for 5 years, so that into 5 comes to 3,20,000 rupees. You can even do 6.4 into 5, find out total rate of return on 10 lakh. You can directly put, I think you get 32%, correct? That way also you reach here. Go to the question. On 31st March, under bonus plan, NAV was 44, correct? That means number of units sold by him on this day will be 1,320,000 by 44 rupee. That gives you 30,000. But did he purchase 30,000? No. This 30,000 is after 2 rounds of bonus, correct? That means again we have to do a similar reverse working to find out how many units he had before that last bonus. You have to do first, and then first bonus will be done later. Yes, this is easier now. Start the calculation. 31st December 2018, that's when you got the first bonus. How to calculate? Units before plus bonus is equal to units after. Same style. We know units after, but we don't know units before. So we start with X plus. Now go to question. Understand it is printed as 1:5. So one bonus for every 5 held. So we can take it as 1/5, which is 0.2. So if you're holding 1 unit, you get 0.2 units. That means you can directly write 0.2x. X plus 0.2x. Actually it is x plus 1/5x. 1/5 is 0.2. So it's okay. And after the bonus it came to 30,000. So when you solve the equation, 1.2x is 30,000. Then x will be 25,000. But this is the number after latest bonus. There was a bonus before this, so you have to go one more step backwards. So it is 31/12/2016. Similar working. Now this will be x plus, question says 1 is to 4, that is 1 by 4, which is 0.25x. So it is x plus 0.25x is equal to 25,000. 1.25x, and on solving you get 20,000 units. So this was the starting point. On that he got bonus twice. So finally issue price will be, as per the question, he invested 10 lakh rupee, and as per your calculation he purchased 20,000 units, so he should have bought it at 50 rupee rate. Old scheme, they used to ask this for 10 marks, 5 marks each for both the plans, but now since 30 marks is kept for MCQ, they are converting these questions to 8 marks here, because they want to ask same question but not give you 10 marks, because there is only 70 marks available for descriptive. So these are now getting shifted to 8 marks category, 4 and 4. Now this is what they wanted. Last line of the question says you are required to calculate the entry rate, issue price. Both we did. So we will take a quick break and then cut. Yes. Question number 13. A mutual fund company introduces two schemes, that is dividend plan, to be understood as dividend reinvestment plan, plan D, and bonus plan, plan B. The face value of the unit is rupees 10. On 1/4/2006, Mr. A invested 2 lakh rupee each in plan D and plan B. So 2 lakh here, 2 lakh there. When NAV was 38.2 and 35.6. Please understand, 10 rupee was the face value. That was not the NAV. I've already discussed this. I'm repeating again. Lot of times while making an assumption, students go wrong. NAV can't be assumed as 10. Face value can be assumed as 10. NAV should be given in the question, or you should be able to find out with an equation. Here face value is 10. The 10 was to be given so that dividend can be calculated. But you did not buy at that rate. You bought it at 38.2 and 35.6 respectively. Both the plans matured on 31/3/2011. So with this you can find out the period. 2006 they started and 2011 plan is over. Particulars of dividend and bonus over the period is given to you, 30th September and so on up to 31st March. Dividend percentage is given, bonus is given, NAV for plan D, D is dividend, plan B is bonus. All the details are given to you. What is the effective yield per annum in respect of the above two plans? Now to find out yield per annum, we have to first find out total yield. Now to find out total yield, you have to find out first investment amount, that is anyway given 2 lakh. You need to find out how much is the sale value or redemption value. Now tell me, in dividend plan, how do I find out redemption value? You can first start with, don't write now, 2 lakh rupee divided by NAV at the entry date. That will tell you number of units you purchased. Then dividend is to be added 4 times. First you have to calculate, but you don't have to pay. Divide by prevailing NAV, you'll get to know additional units added. Keep adding it 4 times, different rates, different dates. Then you'll get to know how many units you have. And on 31st March, plan D, NAV is 40.4. That will become sale consideration minus the original cost of purchase. That becomes your total profit. But that total profit is not for 1 year. You started this on 1/4/2006. So 2007, 8, 9, 10, 11. 5 years. Then the question is annualized. So you can take divided by 5 or 60 months and then 12 months. That is for dividend. Same way bonus plan, you have to find out bonus here 3 times, 1 by 5, 1 by 8 and 1 by 10, and everything is finally sold on 31st March when the rate is 39.7. Again here you will get total return. You have to then calculate annualized return. Start. First, which was the first plan? Heading dividend plan. How many times dividend was calculated? 4 times. So first column date, next column units before, next column additional units, last column units after. Start with first 30th 9 2006. That's the first time dividend is to be calculated. How to find out units before? 2 lakh rupee divided by plan D 38.2. Correct? Because when you started the investment, the rate was 38.2, 5235 units. Correct? Next column, how to calculate fresh units? 5235 units into face value 10 rupees into dividend rate 10%. I think that will give you same 5235 rupees divided by, for additional units you have to take the prevailing NAV rate, and on 30th September the rate was 39.1. When you divide you get the additional units, approximate 134. Therefore units after this will be old 5235 plus new addition 134 comes to 5369. Correct? When you started the plan it was 38.2. When the dividend was reinvested it was 39.1. So fresh unit will be based on 39.1. Now this 5369 becomes base for next time dividend. So next line item 31st March 2008. Now start from 5369 into 10 rupee into 15% dividend. Correct? That will be the amount, but they won't give you amount. They will allot units. This when you divide by that day's prevailing NAV 44.2. You have to be careful while taking the NAV. First you should be in correct plan, and then you have to take the respective date NAV. So 31st 3 2008 NAV was 44.2. So you get 182 units. So old plus new. You will now be sitting with 5551 units. One more dividend on 15th September, 13%. Now base will be 5551 into 10 rupee face value into rate of dividend First amount comes to 7,216, but they're not giving you money. They will allot units on the basis of that day's NAV, and that day NAV was 45.05. This will take you to 5711. Repeat once again, 9138. And now the last dividend is on 27th March 2010, 16% on 10 rupee on the units held, but that will be divided by 44.8. This I think will give you 204 fresh units. Is there a rounding off difference? 204 exact, is it? Huh. So the final number of units 5915. Chances are there you will have 1 or 2 units extra because of the rounding off gap. Totally okay. Now all of this you are going to redeem. At what rate? As per the question. First para of the question, you read last line. Both the plans matured on 31/3/2011. That means that day you have to redeem. So this 5915 into 40.4 will be 2,38,000 rupees. But your original investment was only 2 lakh rupee. Therefore, the difference is your total gain. Simple, 38,966. But we want, as per the question, annual yield. Correct? I think there is 10 extra on screen. Effective yield is 38,966 by 2 lakh rupee. On screen you have 10 extra, that's not correct. It's 2 lakh rupee. Into 100 if you do, you will get the rate of return for 5 years, because you started this fund on 1406, redeeming on 31/3/11. So into 1/5 when you do, you get 3.9% annualized. Yes, this was one plan. Second plan is bonus, and I want you to try. Again, same way, start with original units, 2 lakh rupee divided by 35.6. Correct? Under bonus plan, it was not 38. Sorry, it was 35.6. And on top of that, you have to add bonus thrice into 1/5. Same table, units before, add bonus units, units after. Repeat this. So starting point, anybody, 2 lakh by 35.6? 5618 rounded off, that many units. On that, bonus is easy to understand. 1:5, 1 bonus for 5 held. So it is 1/5 or 0.2. So units before, first column, bonus next column, units after bonus, third column. So 5618, on that bonus will be 1123, and you will have 5618 plus 1123, 6741. That becomes base for next bonus, and that is on 30th 10. Date is very important in all these calculations. 6741 into 1 by 8, and that's 842. One more bonus, and when you add that, I think you'll get 8341 final units. For rounding of difference, you may have 2-3 units plus or minus, totally okay. Don't worry even about MCQ. They're printing the question itself like this: approximate NAV dash, and 4 options. So nearest answer is what you have to take, not to worry. In reality, not classroom book, in real mutual fund world, they don't round off. They show point as it is. If you have any SIP, you log in, you will see even today it will be with decimals. Tomorrow I'll show you my PhD fund units, the pharma fund. Yeah. Yes. Are we getting 8341 approx? And that will be sold at what rate now? 39.7. 331,138 minus original investment was same 2 lakh rupee. So the difference is 131,138, but this is over a period of 5 years. Therefore, gain is the difference between these two. 131, 138, and then simple rate of return annualized 131, 138 by 2 lakh into 100. But then you have to do into 1 by 5 because this is for 5 years. Done. 13.11% per annum.